Good evening, everyone. A warm welcome to our OCBC Premier Private Client Investment Webinar titled Navigating Markets as Economies Reopen. My name is Kelvin, Head of Wealth Advisory for Wealth Management, OCBC Bank. It's my pleasure to be your moderator for this evening's webinar. Before we begin, here are some quick housekeeping notes on how you can participate in this webinar. Firstly, you can ask questions at any time during the webinar. Just click on the tab, post your question, and enter your question into the text box. There will also be a Q&A session after the whole presentation. You can also click on any of the social icons to share during the webinar itself. For optimal viewing and participation, do disable your pop-up blockers. If you encounter any issues, we will first suggest you refresh your browser by pressing F5 on the keyboard. If that does not resolve the issue, do click on the Help button on the navigation bar on top. It is now my pleasure to begin the webinar by introducing our speakers from the esteemed OCBC Wealth Panel. Firstly, we have Selena Ling. She's the Head of Treasury Research and Strategy for OCBC Bank. And secondly, we have Chia, Head of Portfolio Management and Research Office for the Bank of Singapore. I'll now like to invite Selena to share her views on the current landscape for global markets. Selena, please.
Thank you, Kelvin. Welcome, ladies and gentlemen. I'm very pleased to be here tonight to share with you about my second half outlook. Let me start by recapping for you. In 2019, what we were very worried about was essentially US-China trade tensions and geopolitical risk. Well, these headwinds have not gone away, but 2020 came with fresh risks, and that was really in the form of a black swan called COVID-19. Okay? As we're all very well familiar now, we have lockdowns, we have work from home arrangements, home-based learning. We're currently all zombies because we do too many Zoom meetings. We are very familiar with mask wearing, hand sanitizing, and contact tracing as well. Okay? So this is a very brand new world in 2020. Let me share with you some statistics. We can see that actually the number of infections and fatalities are still rising. In fact, now there are concerns that there are actually second wave of infections taking place in Hong Kong, Japan, and in certain states in the US, including Florida and California. But what is quite reassuring this time around, compared to 3 or 6 months ago, is that actually pressure on medical resources has eased, and we see a falling correlation between the new cases and the number of deaths. That means that actually medical experts are getting a handle on this virus. And I think last but not least, mass testing capacity is very quickly accelerating, and hence the ability to quickly identify carriers will help with the contact tracing and containment. Nevertheless, we are a little bit worried about something, and that something is that there seems to be a market disconnect from the very grim economic numbers that we are getting. The IMF has warned, of a great lockdown recession for the global economy in 2020. The main question is, we've had a very sharp drop in the first half. How will the second half recovery path look like? If you look on the slide on the left, actually you can see that 2/3 of people surveyed think that this is going to be a U-shaped recovery, and much fewer people think that this will be V-shaped or L-shaped or W-shaped for that matter, right? But if you look at the slide on the chart on the right, the IMF growth trajectory, it will look a little bit V-shaped to you. That's because we have seen second quarter growth actually basically stall so hard that any form of stabilization will look slightly V-shaped. So you can call this the swoosh shape, or what some people like to say is like the square root shape. There'll be some flattering off in terms of the recovery trajectory after some time. We really have to wait and see. As Fed Chairman Powell said, there is a fair bit of uncertainty surrounding the outlook from here. The positive factor, or the silver lining, really is that central bankers are still very cautious. What this means is that they have promised that monetary policy accommodation will be on tap. If you look at the Fed's case, essentially they have signaled and committed to holding effectively zero interest rates all the way out through 2022. So while they are not quite ready to go into negative rate territory yet, nevertheless we have seen other major central banks venture into this kind of territory. So we see the ECB and the BOE expanding their balance sheet, and most of them pledge that they will keep monetary policy very accommodative for some time. What about the second wave? You can see from here that actually we have seen a big uptick in terms of the cases with the reopening of economies. I think one key question you have to ask yourself, are the cases rising because we are seeing increased testing, or are they rising because the reopening of the economies have come too fast and we haven't had good control about managing the rise of the infections? I think the question really is still quite open-ended at this juncture. What is quite clear is that the growth forecasts have been falling very, very rapidly. The IMF, if you recall, just a couple of weeks ago, downgraded its growth forecast again. So they have gone from plus 3% to minus 3%, and now they are very close to minus 5%. If you look at the OECD and the World Bank forecasts, they are around the same range as well. What is very distinct about this downturn is that it's been very sharp, and secondly, it's been synchronized. All the major regions in the world, whether developed or emerging, have seen the same recession story. Now that we are starting to see reopening of economies, it's quite encouraging that if you look at traffic mobility trends or you look at restaurant dining, they have actually picked up quite a fair bit. That suggests that actually consumer demand is coming back. Of course, the question is whether this can sustain and whether the second round of infections will actually put off some of these consumer spending. I think we will really have to wait and see on this front. There are two key acronyms that I would like to introduce to you if you're not already familiar with them. One is FOMO, fear of missing out, and the other is TINA, there is no alternative. And the reason why I introduced these two acronyms to you is because if you look at the risk sentiment indicators that I've shown in the two charts below, you can see that we hit peak risk-off territory in late March, and since then there has been a rush back into risk-on. So a lot of money have come back into most of the financial markets, whether it's equity or bond, and even commodities, for instance. So this reflects that basically people think that the worst is over. And what is putting a floor to the market fallout really was the very accommodative and front-loaded monetary policy and fiscal policy easing that I mentioned earlier. So where is all this money going? It's going into equity markets, it's going into bond markets. In fact, if you look at the proportion of government bonds that are now yielding negative rates, it's probably near record levels. And you can see that actually a lot of the money are starting to go back into tech because of all the work from home and entertainment from home kind of demand. But I think increasingly there is also will be some switching and rotation into cyclicals as they grow a little bit more confident about the recovery story. So the question we always get is that, well, we are approaching US elections in November. Noise levels are ratcheting higher. It is very likely as Joe Biden's rankings pull ahead of Trump, we'll probably get more saber rattling. And I'll talk a little bit more about this later. I think what we see is that a lot of the manufacturing PMI numbers are starting to come back. Not all of them are back above 50, which is the expansion territory yet, but nevertheless, a few front runners like the US, Malaysia, Vietnam, and China, of course, seem to be coming back faster than the rest. Well, if you look at the factors that are driving the rebound for the manufacturing sector, it's quite easy to see. Because we had the global supply disruptions in a few months ago during the lockdowns, and once these lockdowns are being lifted, we will see the factories reopen. But the demand story is a separate story altogether. As you can see from the services PMI, the global demand shock, I think, will linger longer. And this is really mainly because we are continuing to see a softening in the labor market. And as long as you get continued noise levels rising on the US-China front, I think there will be some trepidation about consumers coming back, especially when there are signs that there could be second wave of COVID infections. So let me talk a little bit about US-China tensions. We have seen expansion from just trade to technology to the security law in Hong Kong, and increasingly US finding like-minded partners around the world to actually target Huawei. And increasingly you also see sanctions on human rights violations and also those officials that are behind the security law in Hong Kong. So a lot of this is noise levels, but there are some implications for the economy out there. I think one is that we will probably see further downward pressure on Chinese growth. And I think China retaliation is something that we will have to watch out for if it happens. And I think we have to adjust to a world where there will be continued disputes and tensions between these two major powers. And last but not least, let me talk a little bit about Singapore. I show these pictures here a little bit tongue-in-cheek because this was really the picture that characterized the circuit breaker in April and May. We basically saw Changi Airport, closing down Terminal 2 because there was no visitors. If you walked along Orchard Road, there was no shops that were open. We couldn't have restaurant dining in as well. And the Raffles Place, which is the bottom right corner, which is where I work, the really only sign of life there were the pigeons. Okay, I'm glad to say that with the transition to phase 2, actually things have picked up a little bit. But the test of the pudding, I think, is whether the snapback that we see in consumer demand in June and going out in July will actually sustain for the rest of the year, because I think the labour market will continue to soften further. So yesterday we got the flash second quarter GDP numbers and it looked really terrible. We had a record 41.2% quarter-on-quarter drop. Is unprecedented. And in fact, if you look, we saw construction and services seeing record declines as well. This was mainly due to the circuit breaker and a lot of the restrictions that we see both in Singapore and around the world. The question is, what are we looking at for the rest of the year? I do think that in third quarter and probably the fourth quarter as well, we are going to still get a year-on-year contraction. So the Singapore economy is not only in a technical recession, but it's likely to see a full year-on-year recession as well. We are looking for a contraction around 5.5% this year, and that's within the official forecast of -4% to -7%. What does this mean for policy? Actually, a lot of the fiscal and monetary policy easing has been front-loaded. If you ask me whether I'm likely to expect a fifth budget, for instance, I think the bar for additional stimulus from here is quite high. That said, I've mentioned that I do expect the labour market to continue to soften, and probably the focus will still be on jobs, jobs, and jobs. Let me end with a few key takeaways. The macroeconomic data remains fairly grim, but I think the worst is probably over in the second quarter. There is still a fair bit of uncertainty whether we're going to get a U, L, or swoosh-shaped type of recovery in the second half of this year. Nevertheless, financial markets have been very forward-looking. Because central bankers remain cautious and dovish, the silver linings really are that we've seen a rapid acceleration of digital adoption and transformation. Regional trade still is fairly intact, and connectivity and logistics is actually improving. So this will actually cap the downside. But we still see continued headwinds from persistent trade tensions and sporadic geopolitical uncertainties. Going ahead, I think public health will remain a key determinant whether for investments, trade, or even how you actually perceive the market. So with that, stay safe everyone. Thank you very much.
All right, thank you so much for that, Selena. To our audience, I think that was a very, very comprehensive overview with regards to what are the things that we should be expecting for. But even as Selena has gone through some of the macro outlook, some of the things that we should be looking at, there will always be that opportunities. And with that in mind, I would like to invite Jean to share some of her views on the Q3 2020 investment themes that one should be looking out for. So Jean, please.
Great, thank you, Kelvin, and thank you, Selena, as well. Well, let me expand a little bit more and building on what Selena's presentation to talk a little bit about investment implications. If this is a tale of two halves, then what are the chapters of our playbook for the second half as investors? We see four key themes. The first is what Selena has also touched on, US-China, the great decoupling. What does that imply for us from an investment basis? Now, the second theme we see is the race to the White House. Again, that will have some implications for the markets. Thirdly, unprecedented stimulus. We've seen how the central banks have reacted during the crisis, and this clearly will have implications on markets as well as interest rates, and that will also guide us in terms of our next steps as investors. Finally, the post-pandemic world, what does that mean? Is it risk or opportunity? Let's talk a little bit more about that. US-China tensions have broadened indeed from what we were used to last year, discussing trade, into a battle for the hegemony, whether it's in technology, investments, healthcare, or geopolitics. As Selena also touched on, this battle for technology will also mean that some of the companies, particularly in China, are actually gathering momentum, exploring changes to their supply chains so that they can be much more independent of the global supply chain. With that, of course, there will come beneficiaries as well as those who are hurt from this trend. In the investment front, we see China gradually opening up in terms of the capital markets for good reason. This is picking up momentum starting with Stock Connect several years back and broadening into Bond Connect and the most recent development, Wealth Management Connect. Now that will have massive implications for the Greater Bay Area as we see the movement of capital within Asia and within Greater China. Healthcare has also been in the limelight and is certainly a mudslinging exercise, as you can see, between US and China now as to the origin of the virus. And that also will have roots that will affect the relationship between US-China even in the months ahead. Now, as we approach November this year, where we have the elections, we can see that regardless of the candidate that draws in terms of draws ahead, whether it's Biden or Trump, the anti-China rhetoric is a popular one. In this research report here on this slide, 2/3 of Americans are anti-China. So regardless of whichever side you're on, Republican or Democrat, it is a very popular rhetoric, and we've all gone through elections. We know how powerful some of these opinions can be, and that will certainly shape the next couple of months in terms of markets as well as the US stance towards China. Race to the White House. Now, there are many questions about, is Biden better for the markets or Trump better for the markets? We see three scenarios. The best possible outcome is actually a Republican Senate and a Democrat House. In this scenario, we think there will be a softening of stance against China from if it was a Democratic. But on the other hand, the pressure to wind back some of the very pro-business policies, such as corporate tax cuts, will be moderated as well in a divided Senate versus House. However, if Trump wins, that's probably a neutral phenomenon for markets. And the worst outcome, we think, if it's a Democratic sweep, because that could potentially bring back or unwind of the corporate tax cuts that have actually been very supportive of markets in the past couple of years. In addition, there could also be, revival of the capital gains tax, which is again a negative for the markets. So those are some possible outcomes that we see. So certainly, as we can see in this slide, we see uncertainties rising as we build up towards November. And so in all the markets and all the investments that we do, this has to be a factor that we are mindful of. Now let's flip over to China. What are the developments there? As Selena also pointed out, the gradual reopening of China, being the first in and first out of the crisis, has actually boded very well. And we can see here also in the recovery in terms of the data and of course building up to tomorrow's GDP data as well. Now we expect that potentially economists like Selena and her peers will start to revise the full year targets for their full year economy outlook, and that also could be very supportive for China in terms of the path ahead. Now in the scenario that we see a lower risk of the US-China trade tariffs, we think that that's also very supportive for the Chinese yuan, and we have also revised our targets here. This in general will also indicate a weakness in the US dollar. Now in March, we witnessed something we have not seen for a very long time. And why is that so? It was a patient that was bleeding at the table, and that was actually caused, of course, by COVID-19. Make no mistake, the pandemic is very much alive and well. We have WHO statistics, and there's 13 million cases right now and a very regrettable number of deaths in excess of 550,000. So this really means that we are going to have to live with this for a long time more, at least for months, if not up to a year. Now, what central banks as well as governments had to do in order to handle and also stabilize the situation in March is off the charts. The amount of stimulus that we see based on IMF data is up to $9 trillion globally in terms of fiscal and monetary stimulus. Add to that another $7 trillion in terms of private debt, we're talking about $16 trillion worth of debt. And debt to GDP ratios have clearly also gone up to almost 270%. What does that mean globally? I think for years to come, we will be living with lower interest rates as well as very accommodative monetary conditions. Now that has investment implications. Here in this chart, you can see that the stress that we experienced in March was unprecedented. Central banks had no choice but to throw over the lifebuoy and extend the stimulus to even very unconventional methods, including paychecks for the unemployed, as well as buying up even high-yield instruments in the US. These are all unprecedented moves that we experience. Now, this lower rate environment is likely to be extremely supportive for yield instruments. And this is so, and you can see here, of course, the treasury yields have been kept low and will continue to be so. This is also supported by demographic change. Here in this slide, we show the number of, or the percentage of those aged 65 and over. As they say, if there's one certainty, it is that we will grow older each year. So certainly this is also very supportive of yield instruments as pension fund balances grow and hunt for yield in order to fulfill their obligations. So this again has implications for the fixed income market. Now this phenomenon is across the world, and you can see here in this slide, whether it's in the developed markets across the board from Asia, US and Europe, we do see lower rates globally. And this means that there will be a search for income regardless of which continent we're talking about. Now, in general, low rates are also going to be very supportive for equity valuations, which also explains to some extent the very rapid rise in equities and also fixed income markets and risky assets in general over the last couple of months. From trough to peak, we're talking about a rise of up to 40% in the US as well as in global markets. Now, what explains this is really the hunt for return as well as the very supportive environment for risky assets, despite the fact that it's quite incongruous with what we're seeing on the economic front. And as some people said, if you come down from Mars and you look at the capital markets, you wouldn't have guessed that we're in the midst of a pandemic and one of the deepest recessions we've ever seen. What is the reason for this disconnect? There's clearly a lot of liquidity chasing assets, as Selena also pointed to. Now, at Bank of Singapore, our preference within the fixed income market is clearly for high yield, and the reason for that is valuations. As you can see here, we do still see some opportunities in the high yield space, and that is where our preference lies within fixed income. Within high yield space, our preference is in Asia. Here again, you can see from IMF estimates as well, Asia is likely to be far ahead in terms of a recovery, albeit very uncertain. It's relatively in a better position than the rest of the world. And then if we zoom in further, within Asia, our preference is for China. China has evolved into what we call the 800-pound gorilla in EM high yield, and we think that the companies now are very much different than they were a decade ago. They're much better capitalized. They've clearly got growth on their side and recovery on side. And certainly in this space, we favor China as a whole and China property more specifically. The pandemic. Many have asked, when will the next pandemic come, or will there be another risk in the horizon? As Selena puts it, that was the black swan. Some academics or some market watchers have called it the white swan, because pandemics will be and other risk will emerge in the next few years. Just a personal anecdote, I was looking through my house for why we had a stockpile of masks from some time back. And what was the reason we held it? I realized that it was because of the haze. And before that, of course, we have had other reasons why we were wearing masks, because the PSI was too high. So what will be the next black swan? It's very hard to predict, but all we know is governments, healthcare systems are certainly much better prepared this time around than even 3 to 4 months ago. So the impact will be on the global economy clearly across the board, but more interestingly is how companies and individuals will pivot in terms of our behaviors, in terms of how we interact, work and live. And this will have investment implications on the companies as well as the industries that we favor as investors. Clearly, in the work from home trend, the beneficiaries will be companies that can support this phenomenon, whether it's software as a service, cybersecurity, as well as digital enablement. We have used our computers and our data more than ever at homes. I don't know how many of you have checked your data bills, are clearly much higher. And certainly these will have to be supported by data centers as well as providers in the ecosystem. E-commerce and logistics, even those who are stalwart restaurant goers or hawker center goers will know that suddenly we've all had to entertain food delivery as an option. That again will bode well for e-commerce, logistics, and the change of behavior is likely to be more permanent than just a flash in the pan. The stay-at-home commerce, clearly not just will we work more at home, play more at home, and watch a lot more videos and game at home. This again will have very positive implications for the ecosystem that supports this. Now, what's on the flip side? There will be industries that are damaged forever, and we need not explain that further than tourism, the intensity of flights as well as business travel. Those are themes that could be here for a long time more. If you recall, post 9/11, the travel restrictions that we had at the border were changed forever, and clearly post-COVID, this will also be something, the way that we travel and the intensity with which business is conducted and the supply chains will clearly be also very different. So that I think will clearly shape the sectors as well as the companies that we favor in the longer run. Now, then again, on the short-term basis, as we say, it's not just important to look at the price, but also at the fine print. And any asset, whether it's positive or negative, can be attractive at the right price. This is a chart here that we show our view right now, which is to stay invested in equities. At Bank of Singapore, we are not overweight equities. We have downgraded that in April earlier this year because valuations were getting too stretched. But that does not mean we're not positive on risky assets. We feel that there are still opportunities, and there's certainly a valuation gap that we think some of the companies that could stand the test of time will catch up. These include the cyclical names as well as financials. So with that, I would just like to pause here and take any questions. I believe we will already have some in the system.
So thank you both Jean and Selena for sharing your views. And I think to what Jean just mentioned with regards to Black Swan event, I mean, who would have thought that even just earlier this year, we will be where we are right now, where nearly the whole of Singapore has been staying at home, and we're only now just re-emerging from our shells. So now to our viewers, let's look at some of the questions that are being posed. To our viewers, please feel free to continue to contribute your questions. We only have a limited amount of time, of course, so we may not be able to answer all of your questions, but please feel free to speak to your client advisors as well should you require that follow-up. All right, so thank you, ladies, once again, and I have quite a bit of questions, which I'll go into. So I think there are quite a lot of questions with regards to what was being mentioned with regards to the US elections. Specifically, now that Joe Biden is in the lead, any thoughts as to how it would pan out, assuming he comes into power, especially after the last couple of years with regards to Trump. So any thoughts on that? Yeah.
Well, I think what's going to be quite clear is that both, whether it's Trump or Biden, they're going to be still tough on China. So we've seen, this pendulum shift from being very pro-China with the Washington consensus, and now everyone is very anti-China in the US. I think the sense is that when China joined the WTO, they were given certain concessions, but since then they have grown, but they have not actually reciprocated in a lot of the trading arrangements, and now there's a lot of pushback. So I guess the environment going ahead will still be relatively tough on China.
Sure.
I mean, we just saw the UK, for instance, also targeting Huawei for the 5G networks as well.
Sure.
So I guess it's they are building kind of like a coalition of like-minded people to actually continue to be tough on China. So I would say that actually it's a relatively challenging environment for China.
I see. And Jean, I think just now you just mentioned in terms of the best case scenario whereby in terms of the Senate, the House of Representatives, if there was a split, But to that point, what would happen if, let's say, for example, policies get stalemate? What are the odds of that? Especially if based on that as a best case scenario, what might potentially pan out? Any thoughts on that?
I think regardless of the victory on either side, I think the focus will be on the tackling the pandemic. I mean, we've seen the numbers in the US; they are, in the record numbers up to 60,000 a day in terms of new cases.
And still increasing, yeah.
And still increasing. And also the unemployment numbers are actually very staggering in terms of these unprecedented numbers. In fact, there is a risk, for example, even in the near term, in terms of the fiscal cliff, as some of the paychecks and PPP will start to run up even in July. So I think regardless of which side wins, I think the focus will be on the economy, focus will be on a relatively supportive policy backdrop in order to maintain the jobs and also grow the US economy. Now, as I agree with Selena, they're likely to be hawkish on China for many reasons. When you have domestic issues, it's always easy to find an external enemy. And so we do expect that this is going to continue for years to come. And remember that, with the rhetoric around ADRs, the American Depository Receipts, a lot of the Chinese companies, which are very large cap, may turn to a listing back in Hong Kong or even China. I think these are very structural changes that will happen in the next couple of years. And you've seen also the very anti-foreigner sort of stance, even in terms of study visas and work visas. We do think that geopolitics in general, regardless of the president, will drive the world and how the rest of Europe, US, and indeed China and Europe and China and India will respond towards the US.
Sure.
I think the other big structural change that we see, and that probably started with the US-China trade war back in late 2018, really that a lot of MNCs were actually considering a China plus one type of approach to their production chain. And I think what happened with COVID-19 is that they reinforced the idea that basically they need to diversify their sourcing and in terms of the value chain. And I think increasingly they will be looking beyond China to ASEAN and possibly for certain commodities for Latin American markets as well. So we are likely to see this phenomenon, what we call glocalisation, which is that really you're serving a global market, but as far as your production and your sourcing of components are concerned, you may want to keep them either by nearshoring or onshoring some of the facilities as well. So we will probably see quite a bit of change in the way global production chains and value chains are being modified.
Sure. So thanks for bringing that up, Selena. I think we just had our elections, the local set elections. So to that point, in terms of that phenomenon that you just mentioned, how will it impact, at least for the Singapore economy? Any comments?
Well, I think in terms of the political takeaways from the recent election results, I think that's been covered quite very, very in-depth in both traditional media and also social media. But let me maybe frame the question in terms of what are some of the economic ramifications I would see as a result of the elections. I think there probably will be a rethink, and not all of it is actually due to the elections per se, but basically this world that we're living in, where you have geopolitical tensions, waxing and waning. You basically have major economies that seems to be at odds with each other, and then within Asia itself, the anchor or the main engine of growth used to be China, but now China seems to be going through this very challenging period. How would the rest of ASEAN cope? Okay. So I think similarly for Singapore, we are dealing with, people always use the analogy, we're like a sampan in a very choppy sea. And I would actually say there is quite a lot of truth to that as well. Basically, we've had to deal, with changing, like I said, global supply chains, the way certain Chinese industries or companies are kind of being singled out for attention. And then even for within ASEAN itself, how do we continue to attract investments into this region when growth seems to be very tepid at the moment? And even for Singapore, because of what happened with COVID-19, a lot of rethinking about, foreign worker issues, whether it's in terms of the numbers, the social distancing, the way we house or transport them, how are we spending our reserves, for instance, in a crisis like this? What does it mean for fiscal transparency and accountability going forward? So there are a lot of economic related issues that I think probably will continue to be re-examined and debated in the days ahead.
I see. Thanks for that. Jean, maybe just to expand upon what Selena has just mentioned, at least in terms of the local economy and the ramifications going forward. Any thoughts with regards to the Singapore equity market, to the stock market?
Yeah, so I think Singapore market still offers a lot of opportunities. Granted, there are key challenges for some of the companies, but I think in terms of valuations, we're still relatively attractive from an Asian perspective. Some of the stocks, of course, that we favor would be, for example, very selectively in the property and REIT space. I think all REITs are not made equal,
Sure.
so we would be very selective in terms of the companies that have been affected, of course, post-COVID and will be affected further, but also companies that potentially are supporting some of the key drivers that I mentioned, whether it's data centers or the logistics and e-commerce area. So again, coming back to the key themes of where the structural winners will be, those will still remain in the Singapore context.
Sure. Okay. So thanks for that. And of course, to our viewers, please continue to keep the questions coming. I'm seeing quite a bit of questions coming in. One common theme that I've been seeing is that there's a lot of concern with regards to the recent run on equities in general, specifically with regards to tech counters. And to our viewers, I think the main concern is whether or not this run is sustainable, whether or not has it gone up too high. So maybe both for Jean and for Selena, maybe could I have your views with regards to the equity run that we had so far?
Yeah, so I think we have to look at it in context in terms of the technology companies. They are clearly the ones that will possibly have the best earnings visibility,
Sure.
if you like, in the coming quarters. And that has also been very supportive. And them being also a large part of the US indices, in fact, they are the reason also why the US market has performed so well. At least a large part of the Nasdaq and S&P 500 and even Hang Seng are very much dominated by some of these tech giants. Where do we stand here? I think right now we're still very positive on some of them because we do believe that this is a multi-year tailwind for technology in general, and also the change in not just behavior but also the innovation that we're seeing in these companies. So coming back to that, I think the way that companies, regardless of their industry, if they're able to adapt and pivot into the so-called new post-COVID economy, these will be the companies that will be able to command the valuations
Sure.
Going forward. So are there legs for tech? I think that there is. Are there risks? Clearly, yes, as well. They are quite over-owned. I think every retail institutional investor has a big weight right now on technology.
Sure.
And so they're priced for perfection, as we say. So any sort of earnings miss or disappointment could have some impact on that. So we will advise investors, as always, to stay diversified, to stay invested but stay diversified, because there could be still risks down the horizon. And another looming risk potentially is, of course, regulatory risks. We always know that in the backdrop, the politicians in the US especially do view the tech giants as a potential threat, if you like, in terms of the what is happening on the
Sure.
Political arena,
Yep.
but also on the geopolitical arena. So every now and then, each of them could be up for targets from either side, both US and China.
Sure.
So I think that they are not without risks, but certainly they have a tailwind on their side in terms of the economy.
All right, sure, thanks.
I would just mention three factors.
Yeah.
I think one really is that COVID-19 has really changed the way we live, the way we play, and the way we work. So I guess technology firms that are supporting this big structural shift will benefit from this trend, and I think this trend is here to stay. On the flip side, I think there are two factors which do warrant a little bit of caution. Jean has mentioned some of the regulatory risks. I think the other one really, which was the theme of the decoupling that we are starting to see coming up between US and China. So depending on which side of the continent you are picking, there may be risk that's associated with the US-China decoupling. And then, of course, last but not least, looking at how big the FANG stocks have actually grown, how much they are powering the rise in terms of the equity indices. Any gyrations by these specific counters can actually warrant a lot of volatility for the equity market. So we have to be a little bit careful as well, because we are getting quite exposed to the tech counters as well.
I see. Okay, thanks. So just to expand a bit more on what was being said, we mentioned with regards to the US, more on the US tech sector side of things. Things in China are bubbling quite a bit as well with regards to the recent equity rally. So much so that I think the authorities have actually come in to say to provide some form of caution. So any thoughts with regards to the recent equity rally on the Chinese side? Is it something that we should be looking at, or what are some of the potential roadblocks that we might be seeing specifically for this space? Jean? Yep.
Yeah. So we just published a report called Not Just a Bull in the China Shop. And what we're trying to paint is also the two sides of this rally, right? On the one hand, China is playing catch up. You have seen a very strong recovery in the US market, 40% peak to trough, and China has literally caught up, but in a matter of 2 weeks.
Sure.
So I think that's certainly a little bit too fast by most imagination, and it's fueled very much coincidentally with also state media encouraging initially the investment in the equity markets, but that has also been followed on by some degree of caution because of the speed of the rise. Now, is it just froth? Is it going to be a repeat of 2015? Our view is China is a very different place in terms of not just the capital market regulations. I think what we experienced in 2015 was literally a lot of margin financing, and as well as wealth management products that went quite unfettered in terms of regulations. This time around, we feel that China is certainly a more mature market now. The depth of investment has also broadened into local institutions, not just retail investors. So I think there is some credence that we should probably ascribe to value investors over there. But at the same time, I mean, there will be the froth that needs to come down. We could see some near-term gyrations and corrections. And underpinning that, of course, as we also point out, is an economic recovery, which is fairly sharp, even though it might be, very short term to look at that right now. But we think that there is a certain level of catch up here, and also the return of capital into the Hong Kong markets as a result of potential listings. That was also a factor that could be very supportive for the equity markets.
Right.
Maybe I'll just add 2 points
Yes, please,
to Jean's answer. I think one is that actually, if you look at some of the reform developments in China, it's actually fairly constructive for the equity market. 2 examples. One is that now they are going for a registration-based IPO pipeline instead of approval-based. So the inflow of the new listings coming in, I think that one would be a lot more regular and frequent. And secondly, they are also trying to reform the delisting process as well. So in terms of the mechanism, you basically have the dynamic inflow and outflow. I think that's actually good for a dynamic market. I think the second point really is that if you look at the Chinese investors, because at the end of the day, it's still very much a domestically driven market for now, even though that will change over time. And actually, if you look at the policy stance, they are still very prudent and tight on property. So for a recovery story, the investors typically would move into equities, and that's probably driving some of the near-term momentum, because really they are trying to price in this China being the first in and first out of the COVID crisis.
Sure. And to that point, I think when you look at China's treatment with regards to the COVID situation, and when you versus it against some of the situation that's happening around the world, I would say that they are probably at the forefront in terms of the recovery, and that could be something at the back of investors' minds as well. Another question that's been coming in is that it's with regard to the amount of liquidity that's in the market right now. What is our view, or what's your take with regards to the interest rate outlook? Do we expect it to remain low? And I think there are some implications on the FX side as well, so which I'll ask in a bit, but maybe can I have your thoughts with regards to the interest rate environment?
Okay,
Yep.
Let me start with the global rate environment. Actually, we have seen in the last 3 to 6 months unprecedented number of central banks making rate cuts. So the Fed, as you know, is very close to zero, and they have committed to keep it there at least through 2022. And then if you look at the ECB and the BOE and the BOJ, they all sound increasingly cautious to dovish as well, and they are basically even contemplating the possibility of expanding their asset purchase program further, or even to basically consider the room to move more or deeper into negative rate territory as well.
Yeah.
So I guess the overall policy tone is very, very supportive. We do expect that global interest rates will remain low, and for those countries within EM, for instance, certain Asian countries, they may actually try to find room to cut a little bit further.
Sure.
Of course, that room is fairly limited for now because of the scale of the rate cuts that we have seen so far. But you realize that central bankers these days are getting very creative, right? They started buying bonds, then they went from govies to corporate bonds, and some of them are doing ETFs, and they are doing high yield, and then, there's no limitation to the range of options that they can have.
One would actually argue that they're getting a bit too creative, actually.
Yeah, so I call this the typical, they're throwing everything, including the kitchen sink, at the problem. So they recognize the scale of this whole COVID-19 pandemic, and they are trying to do their best to stave off what could have been a really, really bad recession.
Sure.
So we are still in a bad recession, but it could have been a lot worse as well.
Sure. And I think there are some questions with regards to a bit more in-depth. What are the odds of, let's say, for Singapore to move into a negative interest rate?
Okay, so let me just follow up from the earlier question, which is, I think for Sing interest rates, it's quite certain that we'll also be in a low rate environment. Okay. We have seen the MAS basically ease monetary policy twice already, once in October last year and once in late March this year. Effectively, we're at a zero appreciation stance for the Singapore trade-weighted band. If you look at, despite all the fluctuations in markets that we've seen in the last 1+ month, actually we are fairly well anchored around the parity of the band. What that means is that we are quite comfortable. Although we're going to see slight deflationary pressure this year, both in the headline CPI and the core CPI, nevertheless, it is, I think, a fairly high hurdle to MAS actually easing monetary policy further. So very frankly, I don't really see them moving into a depreciation stance for the Sing-Nier, for instance. So I think we are really very much in a wait-and-see stage. And I think when the October monetary policy review comes by, it's possible that they will still try to think out of the box on how more to support the Singapore economy. But I think, basically we're kind of in that transition period from the worst of the crisis, which is the second quarter, and moving slowly into a modest recovery story.
Sure. So to your point, the interest rate environment will be expected to remain low, at least for the foreseeable future. Yeah. So adding on to that, so this question I think is more for Jean. Given that we are going to go into this low interest rate environment, so traditionally, at least for the Singapore context, those dividend yielding counters, specifically REITs, they're expected to do better in such an environment. So any thoughts with regard to that, especially if interest rates are expected to remain low?
Yeah, so with low interest rate environment, clearly, as I mentioned earlier in the presentation, there will be a hunt for yield. But we also want to caution investors that it's not yield at any cost. Right, I think today there is a lot of risk still in the market. As they say, you can't change the wind, but you have to adjust your sails.
Sure.
And the way that we would approach this is to also adjust in terms of our selection and also our asset allocation process. Now, firstly, on equities, it is tempting indeed to say that, well, these were high yield stocks or high dividend yielders in the past, so I can now it looks very attractive on a historical basis. I'll point to a couple of examples of why this was not the case. Royal Dutch Shell, for instance, did cut their dividends for the first time in many years.
Yes.
And that was something that many investors had been holding dear, that if it was a company that has paid in the past, it will continue to do so. And even when they announced the cuts, many investors or long-term investors actually saw this as a prudent move because this is a situation of a crisis and companies do need to conserve capital to be able to survive the crisis. And of course, the UK banks were also asked to withhold dividends for the year because they were receiving aid from the government. So and the US has also started to do the same. So there will be risk both from the corporate perspective as well as from the government's perspective of not being excessive in terms of payouts. So this is a period that investors will have to be very wary of expecting the dividends. That's not to say they will not come back, should the companies recover, but certainly there could be a risk of dividend cuts. Now we are hot into earnings season in the US as well, and we've also seen, for example, for the banks going through a very tough patch. For the 3 banks that have announced results, there were loan loss provisions of in excess of 28 billion. Again, very, very large numbers.
Yep.
So it's only to be expected. And Jamie Dimon also said this is not a normal recession. The recessionary part of this you will see later. So this clearly points to some risks as well for many companies within the many markets on dividends. So the sustainability of dividends will be one key issue that we want to look out for, as well as the investor expectations of dividends. Of course, on the fixed income side of things, well, interest rate risk has certainly come off. I mean, we are expecting lower rates globally, and so that's supportive in principle for credit. But what could be picking up is the risk of defaults and credit risks.
Yep.
So again, that's where we are very cautious, and we encourage investors to stay very close to the investments in terms of the research that we do, and we as analysts, of course, do pay a lot of attention to the health and balance sheets of the companies, as well as the leverage ratios of the companies that we invest in, and therefore that could have some implications on also investors. And we encourage, once again, diversification, especially in fixed income, to ensure that any exposure to single names is kept to a very low level,
Sure.
so that this risk is mitigated.
Yeah, thanks for that. We've spoken quite a bit with regards to equities and some fixed income. One question that has been popping in is with regards to the outlook for the dollar, specifically since quantitative easing has been so used so much by the Federal Reserve. So any thoughts with regards to the direction for the US dollar?
Okay, actually quantitative easing is not unique to the Federal Reserve. It's quite rightly used by the other major central banks as well. So we always say this is a contest of the ugly. Who is more dovish, who is doing more QE, who is doing more rate cuts, who is in negative rate territory. As far as the dollar is concerned, actually if you look at the Fed, their stance has been fairly consistent.
Sure.
They will keep rates close to zero for the foreseeable future. They are considering yield curve control as a policy option, although they are not quite there yet.
Sure.
And so far they have drawn a line against negative rates.
Sure.
Okay, so that puts them, I would say, in a sense, half a foot ahead of the European Central Bank, or the BOJ, for instance. Okay, but we always say never. I guess if we do see the second leg down for the US economy because of the new wave of infections that are coming on stream, if they do ever move to another lockdown situation, then you very well could get that kind of L shape or a further step down south. Yeah.
Right.
So it really remains to be seen. But for now, at least, if you look at monetary policy stance, they are being fairly neutral to conservative, I would say, compared to some of the other central banks that are still open to adding to their balance sheet through asset purchases. The other story that we really have to look out for going into the second half of this year really is whether the US economy is going to bounce back faster compared to Europe or Japan or China, for instance.
Yep.
Okay, because we have seen some signs of a pickup in terms of the non-farm payrolls, for instance, that the unemployment rate has dropped. So whether on relative differentials and relative economic standing, do they come out ahead? So I think the picture for now for the broad dollar is actually still very, very unclear at the moment.
I see. All right. And before you know it, we are actually coming to the end, close to the end of the webinar. So to our viewers, thank you so much for your questions. Maybe if I could just ask one final question and probably some final comments from the both of you. We've been hearing a lot of news with regards to the potential for another vaccine. So given that COVID is essentially a medical issue, how would this vaccine, if assuming trials are successful, how may it change certain things? I think our audience will be quite keen to know with regards to that. Yeah.
Okay. We recently held a podcast with some professors in Oxford, and we were discussing this topic as well. I think there are indeed more than 100 vaccine candidates out there, and everyone is hopeful and with bated breath. There's potentially one in the US that's also recently announced very positive results and some promising outcomes. So there we think that we are hopeful indeed that, and for the world, that there will be vaccine candidates. The key now is, of course, the accessibility of this vaccine and the cost. It is heartening to see that some of the pharma companies have actually announced that when the vaccine does come out, they will be also not profiting from it, because this is in the midst of a pandemic, and the royalties will be plowed back to research. Now, this is very encouraging news from also the governance point of view and ESG point of view, to know that some companies actually take the greater good into consideration. So we are hopeful that vaccine candidates will be successful in the near term, maybe in the 6 to 12 months if we're lucky. Now, however, this is a multifaceted COVID-19 pandemic. It is also an evolving virus. So apart from antiviral and vaccine, we are also looking at developments, for example, in data analytics, in contact tracing. There's a lot of work also being done in that front to help to foresee what kind of world we live in terms of the way we do business, the way we do contact tracing, and other aspects of living with pandemic, so to speak. So we are hopeful that this could be a positive thing, at least at the incremental level. What is of concern, of course, is the implementation at each country, and that's probably something we have to watch out for.
Thanks. Yeah.
Okay, I'll just list one positive and one negative factor. I guess the positive factor is that actually it's not so much the vaccine per se, but it's the confidence level, right? So when we see hints that vaccine development is getting underway, or the trials are yielding some tentative positive results, you see the business and also the consumer confidence come back. So it's very much a confidence game. So if we have some sight of a vaccine in the in the horizon, actually the confidence can come back a lot faster, and that will actually aid the economic recovery. The other negative factor I would raise is really that if you look at the world as it is today, we see a lot of fragmentation, right? The whole point about this US-China decoupling is going to be ongoing for a while, and it's going to take many, many facets, whether it's trade, tech, or investments, or the way we do production around the world. And I think that kind of pushback against globalization, against being united, against the credibility of institutions, even within the Federal Reserve. Remember when Fed Chairman Powell got so much heat from President Trump to do the right thing, which is to cut rates on demand. So we are seeing a lot of these institutional credibility being run down.
All right.
So it does mean that in a world ahead, you're going to get a lot more fragmented decision making and less like-minded people coming together for the greater good.
So thank you so much, both Selena and Jean. I think there's a lot of food for thought for our audience. So to our audience, thank you all for your questions. It has been quite an interesting session, and I trust that a lot of these insights have been useful to yourself. I'd just like to end off to say that do spend a few minutes to give us your feedback on this webinar. We will have subsequent webinars, and we want to improve on this based on your feedback. Just click on the survey tab to complete a short feedback form. And also, if you wish to find out more with regards to the latest wealth panel market views, just read our latest monthly outlook by visiting our OCBC.com website or via the OCBC mobile banking app. This brings us to the end of the investment webinar, and I trust that you have benefited from our sharing. Just want to thank you all for joining us this evening. I would like to thank our both Jean and Selena for giving us such useful insights. So thank you both.
Thank you. Thanks.